Picture this. In a world obsessed with rising prices, Switzerland's inflation has stalled at almost zero, but could this economic oddity push the Swiss National Bank into the risky realm of negative interest rates once more? November 3, 2025 at 7:30 a.m. Universal Time Coordinated. Updated on November 3, 2025 at 10:09 a.m. Universal Time Coordinated. Switzerland's inflation rate has taken an unexpected nosedive, hitting close to zero, which is putting fresh strain on the central bank to counteract the overpowering strength of the Swiss franc and to rejuvenate upward pressure on prices. To break this down simply for those new to economics, inflation is basically the rate at which the general level of prices for goods and services rises, eroding the purchasing power of money over time. When it slows to a crawl like this, it can signal economic sluggishness. In this case, consumer prices in Switzerland increased by just 0.1% in October compared to the same month last year, a surprisingly low figure that might ignite renewed talk about the Swiss National Bank potentially slashing interest rates into negative territory as early as next month. For clarity, negative interest rates mean that instead of earning money on savings in the bank, you'd actually pay the bank to hold your money, a tactic some central banks use to encourage spending and borrowing to stimulate the economy. And this is the part most people miss. A handful of economists are predicting that such a cut could happen at the bank's upcoming December meeting. But here's where it gets controversial. While some see negative rates as a necessary evil to combat currency strength and deflation risks, think of deflation as the opposite of inflation, where prices fall and can lead to a vicious cycle of reduced spending and economic stagnation. Others argue it's a dangerous gamble that could distort markets and hurt savers. For instance, historical examples like the European Central Bank's experiment with negative rates showed mixed results, boosting stocks but potentially discouraging investment in long-term assets. What do you think? Is forcing rates below zero a bold economic strategy or a recipe for unintended chaos? Share your thoughts in the comments below. Do you agree that Switzerland might have no choice, or is there a better way to handle this inflation puzzle?